Screens are red, headlines are screaming crash, and it feels like everyone has a panicked opinion. Is this the moment to run for the hills? Or is this the quiet moment that actually builds future wealth? Let's figure that out. Look, when your portfolio is bleeding, it feels personal. It feels final. But what if I told you that what we call a crash is just a very fast, very set? It's not the end of the story. It's just a dramatic chapter. Markets have always moved in cycles. The long, slow climb up feels normal, like it should. But the sharp, sudden drops? They feel like the end of the world. The truth is, both are a natural part of any long-term chart you'll ever see. A healthy market breathes in and out. These drops, these pullbacks, they are the exhale. So what exactly is happening when we see a sea of red? It's simply a moment where sellers overwhelm buyers, pushing prices down rapidly. It's not a moral judgment on the companies or assets you own. It's just market mechanics playing out at high speed. The key is to zoom out. When you look at a chart spanning decades, you'll see these crashes as mere blips on a much larger upward journey. They are part of the story, not the end of it. But knowing that doesn't make it feel any better, does it? The real pain of a market crash isn't felt by the professional traders sitting at their high-tech desks. It's felt by normal people, people like you. You have a job, you have a family to feed. You have bills stacking up. You don't have the luxury of watching charts all day. Your danger is completely different. The biggest risk for you isn't just a falling number on the screen. It's the emotional reaction it triggers. You might get so scared that you sell everything right at the bottom, locking in your losses forever. Or maybe you just freeze, paralyzed by fear, doing nothing at all because you never had a plan for a downturn in the first place. You're checking your phone during your lunch break, seeing your hard-earned savings evaporate, and it feels like a punch to the gut. This is where the real damage happens, when real-life pressures meet market panic. So before you hit that sell button or rush to buy more, stop. Just breathe and ask yourself 4 quick, simple questions. First, are my essential bills for this month and next month completely covered? We're talking rent, food, utilities. Is that money safe and separate? Second, do I have at least a small emergency fund? A buffer of cash that's not invested, ready for life surprises. Third, the money I have invested, is it money I truly, honestly will not need for several years? Be honest with yourself. And fourth, am I acting based on a written plan I made when I was calm? Or am I reacting to today's screaming headlines and my own fear? Answering these 4 questions honestly will give you the clarity you need to avoid a costly emotional mistake. It shifts your focus from the market's chaos back to what you can actually control. Okay, so you've asked the questions. Now, what's the playbook? For a long-term investor, it's not about timing the bottom or making a heroic trade. It's about a simple 3-step process. Protect, observe, and adjust. First and foremost, protect. Your number 1 job in a crash is to protect your real life. That means you do not gamble with your rent money. You do not touch your emergency cash. You make sure your family is secure. The market can wait. Your life can't. Second, observe. Instead of doom scrolling through social media panic, try to observe what's really happening. Which sectors are being hit the hardest? Are there fundamental reasons? Or is it just widespread fear? Become a student of the moment, not a victim of it. And third, adjust. And I mean, adjust carefully. Any changes you make should happen inside your pre-existing long-term plan, not as a panicked reaction to fear. Maybe you slightly rebalance, or maybe you do nothing at all. The key is, the adjustment comes from strategy, not from terror. So, when does a crash stop being a threat and start becoming an opportunity? It happens when you have 2 things, a financial buffer and a long time horizon. If your immediate needs are met, and you're investing for 5, 10, 20 years down the line, then a market crash starts to look less like a disaster and more like a sale. Think about it. The prices of quality assets are suddenly marked down. The long-term story of innovation and global growth hasn't stopped, but the entry price just got a lot cheaper. This is the sale for patient people. The key here isn't to go all in, trying to catch the absolute bottom. Nobody can do that consistently. The smart move is to continue your regular, disciplined investing. If you were putting in $100 a month before, you keep putting in $100 a month. This is called dollar cost averaging, and it's just your superpower in a downturn because your fixed amount of money now buys more shares than it did before. It's a quiet, unemotional way to take advantage of lower prices without taking on huge risks. To navigate this volatility successfully, you need to set some hard rules for yourself, and you need to decide on them now while you're relatively calm, not in the heat of the moment. Write them down. Put them on your desk. Rule number 1, absolutely no leverage. Do not borrow money to invest ever. It's the fastest way to get completely wiped out. Rule 2, no all-in bets. Don't throw your entire life savings into one asset because you think it's the bottom. That's guessing, not investing. Rule 3, stop checking the price 10 times a day. It doesn't change the outcome, it only fries your nervous system. And finally, decide on a maximum percentage for your riskier assets and stick to it. If you decided you're comfortable with 10% in crypto, don't let fear or greed push you to 50%. Your rules are your shield against your own worst emotional impulses. Finally, let's talk about the pain. If this market downturn is really hurting you, if you're losing sleep and feel sick with worry, that's not just a feeling, that's valuable data. It's the market giving you a personalized lesson. The pain is telling you something important. Maybe your risk tolerance was lower than you thought. Maybe you were overinvested in speculative assets. Maybe your emergency buffer was too small to give you peace of mind. Don't waste this lesson. Use the pain as data. Write down what went wrong, what felt the worst, and why. Use this experience to design a calmer, more resilient financial setup for the next market cycle, because there will always be a next cycle. Take this opportunity to build a plan that truly fits your life and your temperament, so that next time the screens turn red, you feel prepared, not panicked. Please remember, this video is for educational purposes only and is not financial advice. Always do your own research. For more content to help you find calm in the financial chaos, make sure you subscribe to the channel. Thanks for watching.